I know from working with a lot of traders for a lot of years that most moves to break even, both in the moment and even a designed process that calls for a move to break even, is an emotional crutch. Unfortunately, that's what it is. Someone is asking when I use the term trade what is, it's almost a psychology thing, but it brings you back to true market generated information, what you're actually seeing, where the acceptance picture is relative to a line in the sand. Is it above or below? Not do you think it's going to change for some reason, not do you want it to do something for some reason, but what is, with your key variables, what is the market giving you? And you can only trade that. You can sit on your hands if it's not what you want to trade. You can wait for the what is to line up with a good trade for you, but you only trade what is. That sounds like common sense. That sounds like a stupid kind of point to make, but believe me, guys, I see traders every single day who are trading something they want to be, or that they wish was, or that they're trying to make up for something that happened in the past, or that they think will be in the future. Trade what is. It's a big deal. Easier said than done, right? What's the formula? Your expectancy equals your win percent times the average winner, right, in dollars or whatever unit you want to use, minus your win percent, aka your loss percent. But we'll do it like this: 1 minus win percent times your average loser. And if this is a minus, you use the absolute value of your average loser. If this is a plus, you got to make this a negative number right here. That's expectancy. That's the math that all traders are trying to put together through tactics and indicators and momentum and trend and trade management. You're trying to figure out what combination of how often you're right versus, and it's a trade-off, there's no free lunches, versus how big you win versus, hopefully, for most people, how small you lose. The interplay between those two things is how you ultimately find a process, repeat it, and then grind that edge over time and over trade after trade over the next 100 trades, 200 trades. So there's the backdrop that you didn't ask for, Chris, but that's what I just want to lay that foundation for everybody out there. So now when we talk about structuring our business with maybe tight stops or wide stops, if we're the trader that comes in and gets long right here with a stop right here versus the same trader, or a different trader, but the same market environment, who gets long there and places a stop right here, okay? Trader A is going to have a lower, how often, right? A lower win percent. Trader B is going to have a bigger win percent at the cost of risk reward, right? If your stop is this wide, well, guess what? You got to make this much just to get to 1R, right? If my stop is this wide and both traders take profit at this same level, how many R did daddy make, right? Let's just call it 5.
Marry my bias is where I take big losses. Any thoughts?
Oh, I love this. I love this question. Getting married to your bias is something that creates big losses. And often, no offense, I'm talking to myself here, often what we would call dumb repeating losses, right? Those days where market's in a downtrend, you look back at the end of the day and you're like, holy crap, I tried to buy it 8 times in nothing but a downtrend. How stupid is that, right? Well, it doesn't feel so stupid in the moment, does it? Right? It's only with the benefit of hindsight you can look back and say, that was stupid. I hate myself for the way I did things today as a trader, blah, 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 blah. So you have no bias unless you have a line in the sand where that bias changes. Problem solved. I'll repeat it. You don't have a bias. You have a problem. If your bias does not have a line in the sand as to where it's invalidated, then you can have a bias, and then you can try to trade it in a healthy way without taking repetitive, stupid, big losses, whatever, right? If it's truly big losses, then that's a risk management problem. if you're trading bigger size or taking bigger risk per trade than you should. More times than not, it's people who fail to respect that the market has told them your idea was wrong, buddy, right? So let's not sit here and bang our head against the wall. That's the deal. Learning to see, and this is why Chris and I use the term acceptance. When the acceptance picture changes, let's say I have a good line in the sand and I want to buy from above that area. If there's an acceptance picture, aka the market holds, let's call it substantially enough below that line in the sand, the idea is over. I can either now look for shorts if that's part of the plan, hypo 2, if you will. This is why people have 3 hypos. It's because you want to have a bias, have a view on risk reward, but then you have to be flexible and nimble when it changes, when it tells you that it's wrong. It's a big deal. It's a huge skill to learn. I know from working with a lot of traders for a lot of years that most moves to break even, both in the moment and even a designed process, that calls for a move to break even, is an emotional crutch. Unfortunately, that's what it is. Emotional crutch for most. People who rise above that a little bit are people who are trying to apply a good, what they've heard, blanket trading statement, right? Never let a winner turn into a loser. Well, heck, let's put the stop at break even. Great. We accomplished that mission. That is too simple of a view. What matters is how much oscillation is that market having around that area historically based on your style and the way that you're timing up those entries. And would a move to break even early in the trade or late in the trade or at any point in the trade make sense based on essentially the statistical view of how that market's moving around your areas of interest? I know, for example, in more of a mean reversion type of entry, that there's statistically a lot more back and forth, a lot more wiggling that a market is going to do because it's rotational by design. It's more sideways by design. There's more back and forth by design. So moving a stop quickly into break even or trailing it into positive territory is quite frankly not the smartest thing to do. In a really clean momentum driven market where you're going with a continuation and you got a really tight stop and you're looking for it to go, then by all means, a really tight stop and therefore essentially being at a move to break even or trailing past break even makes a ton of sense. The right trade management and trail or no trail of a stop depends on what you're trying to do and your style. Bullcrap blanket trading statements that everybody should do this, nobody should do this. It's garbage and it's ignorance. You've got to take a look at your strategy and what's best for it. However, don't make emotional decisions in your trading. Don't move to break even because you're scared. Don't move to break even because it lets you feel just like, oh, now I'm risk-free in the trade. You could be shooting yourself in the foot getting risk-free in the trade. It could be a bad thing. Those are my thoughts.
This presentation is for educational purposes only. All of the symbols, trading ideas, and live trading are for demonstrational purposes and are not recommendations or trading advice. Past performance may not be indicative of future results. All of the information and opinions expressed by third-party guests are their own and are not necessarily those of NinjaTrader, LLC. Trading futures involves substantial risk and may not be suitable for everyone, and trading futures can result in losses greater than the initial required margin. Traders should only trade futures with risk capital. Risk capital is money that you can afford to lose without jeopardizing your financial security or current lifestyle. You can find additional disclosure information on the NinjaTrader website.